Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions from your own financial conclusions and make your own financial decisions. This is Blockhead Traders for the week of March 30th, 2025. And in this week's episode, it's just myself, Sprocket888, and I want to take a look at a recent earnings trade that I put on the Dollar Tree. That is DLTR ticker symbol. And what I want to do is call out one of the factors in my earnings setup that I believe are one of the key ingredients into being successful and generating the type of return that I have been able to generate on a lot of these things. And that is volatility. And why exactly does volatility matter? I want to take a little bit of a discussion around volatility, as I do think that that is one of the biggest factors in the earnings trade. Is you have to find volatility that is extra extended and elevated. And we'll take a look as why that does what it does when it comes to trading earnings. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to tiliting.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Viper XL007 also has a link there now as well. Last, this is available in an audio-only format wherever you get your podcasts. So look us up there, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's content. And it's going to be a brief episode this week, and it's all about volatility. And what the heck is volatility? Why does it matter? And why is that such a key ingredient in my earnings trades that I put on? Now, generally speaking, volatility is just the measure of fluctuation. So the more volatile something is, the more rapid the fluctuation can be, the more movement that the entity will have. And so when it comes to stocks, volatility basically is describing the amount of expected move or the amount of variance from day to day on the move. So it doesn't really ever say, how high can a stock go or how low can a stock go, but really it speaks to the amount or probability at which a movement and the magnitude of that movement would be, not necessarily the direction. And why does that matter? Well, that matters because in the way that I do a lot of my earnings trades is I sell options. Now, a lot of people buy options, and that's okay. But basically, if we think about an option price, you are looking to the coupon holder. Think of it like a coupon, and the coupon holder is looking to be able to cash in on that coupon. So the buyer of the option is looking for that coupon to be worth more money tomorrow than it is today. So they're looking for that coupon to become a better deal, if you would, as time goes on. Now, the coupon seller is basically saying, well, I kind of want this coupon to decline in value over time because I don't really want to honor the coupon. I would rather just sell the coupon, keep the premium, and once the coupon's expired, then it's worthless and I get to keep my premium. And where volatility comes into play there is the coupon that they're buying or selling is to make a trade at a given strike price or given stock price of the underlying. And what that means is, or why that's important, is because the higher the volatility, the more probability that the price will vary. And so there's more uncertainty around where it will land. And that uncertainty is basically premium, or you will pay a premium for that ability, right? So if you have a very volatile stock, the probability of moving into one of those strikes is higher because you're going to get more action, more movement out of it. So that could carry more value to you because you might be able to reach a certain level that you wouldn't be able to reach if the volatility was much less than that. And when it comes to kind of insurance or preparing for something, a lot of times the expected move or the anticipated move or people's perception of the move is often overstated than the reality of the move. And what I mean by that is, things can sure sound a whole lot more dangerous or a whole lot more scary when you're talking about them. But when the thunderstorm comes through or when the weather comes through, sometimes it turns out to be not as bad as people had talked it up to be. I live in the Midwest, and one of the common things in the winter is snow, and oh my gosh, the media and the weather people will talk about snow. Get out to the store, get your goods. The snow's coming, and people will basically start talking about it and becoming more and more paranoid. And the threat of the snow actually becomes much worse than, in many times, the snowstorm itself. We might get a few flakes, you get maybe an inch on the ground, where they were basically kind of, hyping it up to blizzard-like conditions. Not quite to that extreme, but you get the point. The point is the general population overreacts to what the reality of the situation is. And that's really a lot like volatility. So when you go into anything that is unknown or anything upcoming or any kind of uncertainty, a lot of people will, be scared of that uncertainty to the upside and to the downside. And that unknown causes people to basically overestimate that price movement. And that estimation of price movement is volatility. That's the manifestation of volatility in the option price. So why does a lot of this matter? And the reason it matters on earnings trades is because earnings is exactly a known point in time in which the unknown becomes known, which is really a special thing because a lot of times you'll get volatility buildup, but people don't know when that volatility is going to come out. It does eventually come out, but it's harder to know exactly the date and time in which that will occur. With earnings trades, you kind of know the exact date and time. Now, the outcome you don't know, but you do know that the uncertainty around earnings will disappear as soon as the earnings are announced because that unknown becomes known. And as soon as something is known, people can put in the appropriate volatility. That it's like the snowstorm that arrives. Once the snowstorm is here and the snow falls, everybody can look around and assess, oh, was it as bad as I thought it was going to be? Was it better? Was it worse? And then that knowing of it basically removes the uncertainty. And because you don't have the uncertainty, it removes the volatility. And so it is a classic situation of a volatility contraction. And why does that matter? Well, that matters because if you're like me, you believe that most of the time that price movement is going to be overstated, which means the expected move on the stock will typically be less than what everybody is anticipating. It's the massive snowstorm that never really arrives. And so what I do is I go sell that premium to all the people that are buttoning down for the snowstorm because I am betting that the snowstorm isn't going to be as bad as everyone talks about. And as soon as that volatility goes away, those options that I sold lose almost all of their value, and you can close them out, and I, keep that premium that I sold. Now, for me, this doesn't work in any given earnings. Yes, it could potentially work, right? Because every earnings is an unknown. But what I like to look for is those kind of mega movements, right? The time in which volatility is just really overstated or people are really concerned or excited about a particular earnings announcement. And so something that has really, really pumped up their volatility, because everything will be more volatile around earnings. But what I'm looking for is things that are extra extended volatility going into earnings, because generally my opinion is that will contract post earnings. So why not go for that balloon that's overinflated, like extra big? You get more pop when it goes. And that's really where I was at when it came to the Dollar Tree or DLTR. It was something that was in the 70th percentile of volatility, which means, only 30% of the time did it have less volatility in it than before those earnings. So let's take a look at this chart around DLTR. Now, like I said, this is about a 20 delta strangle. And the further examples, I'll give you something similar to that delta, which means whatever the option chain was, I went out to about a 20 delta put and a 20 delta call, and I sold each of those. So in this particular example, and I did this just a few days before earnings. So earnings on this was on March 26th. I put this trade on the day before earnings on March 25th. And these earnings or these option coupons are going to expire on the Friday of earnings, which was March 28th. And That 20 delta on the 25th was about a $60 put and an $80 call, which said, hey, when Dollar Tree puts out its earnings, I believe it's going to end up, the stock price will stay above $60 or stay below $80, somewhere in that range. So as long as the stock stays within that range, come Friday, those options will be absolutely worthless, and I will be able to keep all the premium that I collected. And so I sold 8 of these contracts at $1.96 a piece, which worked out to be just shy of $1,600 that I collected. Now, the buying power that I consumed on this was about $8,000, which was roughly about $1,000 per contract. And so I did 8 of them. That's where you get the 8,000. And if you take the premium that I collected, divide that by that buying power, because that is the amount of purchasing power that I cannot use for other trades in my portfolio. So it is the capital that has gone into this investment, even though I did not say goodbye to that capital. It basically was sequestered as kind of an escrow account, depending on how this pans out, because if I have to, make good on these coupons, the broker wants to make sure that I have a certain amount of money set aside to make good on those coupons and delivering on them. And so if you take those two and divide them out, you'll get roughly a 20% return on capital. That's important because this trade is only out there for a few days. As soon as I close these options out, or when they expire and worthless, then basically all that buying power is returned to me. So I wouldn't say that buying power is necessarily at risk per se, but it is kind of sequestered as part of this trade. Now, if I had to purchase those 8 contracts, remember each contract is 100 shares. So I might have had to purchase, 800 shares of DLTR at $60, or I might have been forced to sell 800 shares of DLTR at $80, depending on where the stock price ends at the end of expiration. But I was kind of okay with that. But generally speaking, you can look at this as return on capital, and it's about a 20% return on capital. Now, the other thing I always like to show is a Flappy Bird chart. And so let's take a look at the Flappy Bird chart. So looking at the Flappy Bird chart right here, I call it the Flappy Bird chart because it's kind of like that mobile game back in the day where you would kind of control the bird and you can make him flap up or let him glide down. And you'd have to get him to go in between 2 obstacles. And in this chart here, the obstacles are the 2 red boxes. The one side of the red box is where I open the trade. The other side of the red box is where the trade ends and the options are expire worthless. And what you want to see is you want to see that price stay in between those 2 red squares. We don't want to breach them. We don't really want to touch them, although if they come down there, okay, great, you can do it, but we want it to finish in between those 2 red boxes. And those are at a $60 put strike on the bottom and an $80 strike on the top. And so as long as the underlying stayed in that very massive $20 range, and this is really only a $70 stock. So we're talking probably a 12 to 15% move to the upside or to the downside that was being priced in. And that really comes from that volatility, that uncertainty. And that's why this is such a secret ingredient here. It's not so secret, but why it's so important of an ingredient, because that direct volatility is what really inflates the price. And that inflation of the price allows you to go further out in time, or not time, but further out on your strikes to be protected, or to basically give a wider area to land the plane in, if you would. And so, if you don't have a lot of volatility going into earnings, you're not going to be able to protect or to absorb such large price swings. If this was a much lower volatility, I probably wouldn't have been at the $60 and $80 strike. I might have been at the $70 and $75 strike, or, less dollars above and below where the stock was trading at. So in order to highlight the importance of the volatility when it comes to this stuff, I went out and I did a little screening for April expiration. So that's in a couple of weeks, the monthly expiration. And I looked for 2 underlyings that basically had a lot of the same characteristics of each other, except for one thing, and that is the difference in volatility. And I wanted to find something that had low volatility and something that had high volatility. Now, this is different than the historical volatility that I look at going into earnings trades, But for the purposes of highlighting the impact of volatility to the pricing and the return on your capital, this example will be perfectly fine. And so the two underlyings that I want to bring up are UPS and Reddit. The reason that I picked these things is because their volume of trades are very similar to each other, which means the same amount of trades are changing hands each given day. The other thing is their price is about the same, because one of the other factors in an option pricing is what does the underlying trade at. So options on a $20 stock are considerably less dollars than options on a $1,000 stock. And that's because of the notional value that is being represented by that option. So if we pull up these underlyings that I'm talking about, or this table and this chart comparison, you'll see what I'm talking about. So right here, the trading price of UPS was $111. Trading price of Reddit was about $110. Now, these are completely different sectors, but that doesn't matter. UPS trades about 4 million shares a day. Reddit is trading about 6 million shares a day. Yeah, you could say that that's pretty substantially different. But when you're talking about volume, once you get kind of over 1 million shares, your liquidity is really going to be the same. And that's why I try to find, or wanted to look at, higher volume underlyings, because they tend to have better liquidity. Better liquidity means tighter spreads and better fills. So the more accurate or the more efficient the market is pricing those things at. So what's the difference in volatility? So UPS was looking at around a 29% volatility, while Reddit was having about an 87% volatility. Now, this is spot volatility, so this is the expected move of those underlyings at any given moment right now. So because UPS has a 29% volatility, the expected move, or the expected change in UPS each day, is much, much less than Reddit. So what does that mean? That is manifested in the next one of 18 delta strikes. So what I did was say, okay, if you go out 18 delta on the put side and 18 delta on the call side, what is the underlying strike price that is that delta? And so on UPS, 18 delta was about $105 put. Well, on Reddit, it was a $95 put, which means the exact same delta you could go $10 further with Reddit than you could with UPS. Extremely similar on the call side. UPS's call was about 117 before you got to that 18 delta strike, whereas Reddit was $133 for that call. So what does all that mean? Remember, I tell you, I take, 18 delta, 20 delta earnings trades, which means I am selling the 20 delta put and I'm selling the 20 delta call. So if we look at the 18 delta strangle here and where I collect, so if I sold on UPS a 105 put and a 117 call, I would collect $1.17 or $117 per contract. On Reddit, that same probability strike, okay, so the difference is, yes, the strikes are further out, but because one has more volatility, the probability of hitting that 18 delta is the same probability for UPS and Reddit. It's just that strike is different between the two. So the probability of hitting 18 delta is in both cases, an 18% chance. It's just that 18% chance is further away in Reddit's case at 95 versus closer to the money at 105 for UPS, which is both of them trading around $111. So on Reddit, I can put those strikes further away and collect more money. So a 95 put and a 133 call on Reddit will net me $4.35. Both of these trades have the exact same probability of winning. Both of them. They're both 18 delta. So one has a higher reward. Now, you could say that's because there's more risk, but again, it is statistically stated here that they have the same probability of reaching those strikes. Now, the buying power, this is how much money do I have to set aside, ironically for both of these is the same per contract. About $1,700 per contract do I have to set aside to make this trade. So you can see right here, your risk to reward, if we call that return on capital your risk, That's not truly a risk, but from this standpoint, it is what you're putting up in your buying power. You can see your return is significantly higher under that higher volatility trade at 87%. I can collect $435 by surrendering $1,700 in buying power, or I can collect $110 by surrendering that $1,700 in buying power. And you might say, well, Sprocket, that Reddit is so much more volatile. It has more of a chance of being, failing. And I would say, no, that's wrong. You would be correct if I did the exact same strikes prices. So if I sold that Reddit at 105 and 117, you're right. There would be a greater probability that I would lose that trade because I am now doing probably around a 25 or 30 delta probability. But that's not what I'm selling. What I'm selling here is the exact same probability. And this is exactly what I wanted to kind of call out and highlight, is that when you deal with the probability or with the volatility and you target things that have an extra extended volatility, you are increasing the amount of premium that you are going to collect. Well, you're not increasing the buying power that you have to put up. And if you target your strikes by the same delta value, that is your deterministic or determined probability of winning, or in the converse, depending on if you're buying or selling, but an 18 delta in my position when I sell options means that I have a 72% chance of succeeding, which means there's only an 18% chance that those strikes are going to be breached, which is bad for me. And that delta, that's exactly what that means, is it is the statistical probability that the option will expire at or above that strike price. So that brings us to the end of this week's episode. I wanted to keep it real quick, and I wanted to keep it real focused on volatility, because a lot of times that extra volatility generates extra premium. And if you are trading at a particular delta value, it really doesn't matter. That delta is the representation of the statistical probability of being at that strike or above. And so why not trade at that desired strike, but with more volatility, thus more premium? So if you are selling the premium, that's more money that you get to put in your pocket. Now, you can flip all of this advice if you are buying options, and maybe you want to only buy options that have lower volatility because you're paying less of that premium. But you might also, want something that is, you might want to pay up for that premium because it means there's a higher probability of more movement on that stock. So, it just goes to show that the earnings and why I target that extra extended volatility is because of the extra premium that I get to pocket. And the secondary one is because people really overstate volatility. Just like a snowstorm in the Midwest, they talk about it a whole lot more than the actual what comes down once the snow has fallen and people go out there like, oh, I guess that wasn't as bad as we thought it might be. And when you are selling that premium, that's what you want. You want to sell things when people are panicking. You want to sell things when people are overstating expectations. You don't want to sell them once the unknown is known and people know what to expect. That's not where you get your edge. That's not where you collect that other premium. And that is why going into earnings, you have the unknown coming up. And so that is where you will have the peak of volatility because the unknown has not yet been known. And then as soon as those earnings come out, the unknown becomes known and that volatility completely disappears. And then you just need it to settle inside that range that you have sold that strangle. And then you get to keep all that premium if you land in between those strikes. And that is really the core at premium selling around earnings and why it works like it does. And, the key thing is I'm selling these options, the expiration of that week. And that's important because the other variable we're not talking about today is time. And time equals value. And the more time you give, the more value that's in there, and the less volatility contraction if there's still a lot of time left on the option, which is why I target that expiration of the option the week of the earnings event, or the week of that unknown becoming known. So good luck out there with all of the things that you're trading. Hopefully you're finding trades that excite you and interest you. Volatility has really been rising, and so I have really been enjoying that. But good luck to you. Have fun, and remember, think outside the block.